Welcome to the Introspect edition of our Trading Psychology series. This video will guide you through a trader's journey, from the mental trap of avoidance to the freedom of acceptance. We'll cover mindset transformation, risk management, and precise position sizing. Our journey includes understanding the trap of loss avoidance, learning the cost of avoidance through a case study, and making the mindset shift to loss acceptance. We'll explore technical protection using the ATR buffer, discipline and position sizing, and a discipline checklist before finally building your trading system. The deki-jegi mindset, or loss avoidance, is a silent killer of trading capital. Traders have selective vision, seeing profits clearly but keeping losses blurry. This brain trickery sets a trap. When losses materialize, it leads to quote, tilt and revenge trading. A staggering 85% of retail traders lose money, mostly due to psychological factors, not poor analysis. Meet Ramesh, a retail trader whose mantra was avoid loss. He bought a stock at 500 rupees with no stop loss. When the stock dropped 10%, he froze. A 20% drop led to panic, and a 30% drop caused him to double down, hoping for a rebound. Ramesh lost over 50,000 rupees. His disaster wasn't from bad analysis, but from a bad mindset. Professionalism begins when you treat a stop loss as a business expense, not a failure. The mindset shifts from avoidance, where you panic and hope not to get hit, to acceptance. Acceptance leads to peace, knowing that the loss is merely the cost of finding out if your trade was correct. Losses are tuition fees. Only disciplined traders graduate. To protect your psychology with math, we use the ATR, or average true range. Obvious stop levels are often hunted by market volatility. The ATR rule suggests placing your stop at 1.5 times the ATR away from your entry. For example, with an ATR of 20 and an entry of 500, the stop is 470. ATR-based stops can reduce whipsaw losses by up to 70%, preserving capital and clarity. Even with the right stop, discipline collapses if your quantity is oversized. Position sizing is the math that keeps emotions in check. It involves defining your risk per trade, calculating the stop distance, and then applying the formula: quantity equals risk divided by stop distance. This ensures your maximum loss is always controlled. The discipline checklist reinforces ritual over memory. Before your first trade, ask yourself 4 questions. Is the risk defined? Is the loss accepted? Is the exit automated? Is the position size calculated? This checklist transforms abstract discipline into concrete, repeatable actions. This week, we invite you to reflect on your own trading behavior. Consider, have you ever oversized a trade? How did it affect your mindset? What changed when you started calculating quantity with discipline? Share your story to help the community move from individual suffering to collective learning. Introspect is building tools to turn psychological shifts into functional systems, including a trading behavior assessment, position sizing calculator, and a discipline tracker. Remember the Introspect mantra: profits are optional, discipline is mandatory, losses, sahi hai, quantity, calculated. Trading is not about predicting the future. It's about managing the present. When you accept losses as the cost of doing business, you stop fighting the market. The shift from avoidance to acceptance is a transformation in how you see yourself as a trader. Remember, acceptance plus math equals professionalism.